So hello and welcome to this Edison audio interview with Nick Greenwood and Charlotte Cuthbertson, the fund managers of Miton Global Opportunities, or MIGO. It's Tuesday, the 23rd of June, and I'm Sarah Godfrey, Director in the investment companies team at Edison. So to start off then, Nick, you've got a long history in investment trusts. Tell us about your life in investment trusts and the genesis of Miton Global Opportunities.
Well, I think arriving in the investment trust world came as an accident. In the mid-90s, investment trusts were on a bit of a roll, and there were lots of new issues. And the company I then worked for wanted to create a new fund, and they decided that it was going to be a fund of investment trusts because that was the hot sector of the day. And I had a stockbroking background, so they decided it'd be a good idea if I took the fund on. So his historical accident, and the rest is history. So that was 25 years ago. I think that really thinking about what sort of fund it would be in the world, you've got to go back and see what was happening at that time. You know, it's basically fund managers in those days tended to hug the indices much more closely than they do today. And we had that situation where Vodafone took over management. It became 14% of the index. You could ask a UK fund manager what was the stock they were most bearish about in the FTSE, and very often correctly they would say Vodafone. But the way they expressed that bearishness was to have 10% of the fund in it, because that was underweight the index, and they had 10% relative to a 14% weighting. Trying to explain that to somebody in the real world, starting a conversation, well, thank you very much for giving me your life savings to invest. What I've done, first of all, is to put 10% of your life savings into the shares we think are going to fall the furthest. That was the world we lived in. So we wanted to create a vehicle where we just were trying to make money. We're not going to slavishly follow an index, and therefore that's why the trust has a cash benchmark. I think over the years we've evolved into deep value and special situations, not because once I had a clean sheet of paper and I thought that was a great idea. It's just a constant reaction to how the investment trust world has evolved, and the enormous opportunities really are on the overlooked and unloved trusts that can trade. In current markets, we've got plenty of things in the portfolio that are trading at 25 or 30% of the value of the underlying portfolio. And if you can see a catalyst why that should change, that creates, a big uplift without needing the underlying assets to actually perform. So over time, you do have to have an ability to watch paint dry, but it's a style that's evolved, and we never sat on day one and had a game plan for this is what we're going to do. So that's the potted history. I could give you 40 or 50 minutes on the history of investment trusts and how we invest, but I think probably give the listeners a breather.
Okay, thanks very much. So Charlotte, then to bring you in, what are you looking for from an investment that you might buy for MIGO?
So as Nick was saying, MIGO specialises in looking for these deep discount special situations in the investment trust world. So as Nick was saying, we're looking for the ability where the possibility of buying good assets for as little as 70 pence in the pound. And what we're really looking for is the NAV to be rising and that discount to be narrowing, because that's a really powerful combination for returns for investors. And as Nick said, you do have to have a little bit of watching paint dry when you hold MIGO, but over the longer term, we have produced some pretty good performance through this strategy. One thing I would also say is that sometimes the way to extract that value can be the end of the trust itself. So we do have in the portfolio some trusts in realization where they're trading at a discount and handing that cash back at NAV, which is again another powerful combination for returns.
Thanks, Charlotte. So putting that into practice then, Nick, in the recent sell-off, how active were you with the portfolio? What sort of things were you, if anything, were you buying and selling?
Well, what we saw was just a widespread slashing of the prices to levels that were unpalatable to sellers. But the market makers didn't particularly want to sell stock at those levels. but you can actually buy a modest amount of shares every day at those lower levels because there is a regulatory minimum. So we did a vast number of trades, but very often they were typically in £5,000 or £10,000 worth. So we topped up a lot of the things right away across the range in March, in the middle of that crisis. I think the big opportunity was because the investment trust world is increasingly coming home for alternatives, that the alternative asset classes got marked down just as harshly as equity funds, even though the return profiles are rather different. So a good example of something we bought was Ground Rent's Income Fund, which fell from around £1 to 67p, at which point it was yielding over 6%. Now, when you look at the underlying portfolio, it is a large portfolio of very small individual ground rents. Typically, the annual fee is 250 quid. Whilst everyone's having a tough time out there, I doubt anyone is going to not pay their ground rent. You're not going to fail to pay 250 quid and put your home at risk. Yet you could have bought these shares at a very, very steep discount. Other examples: Tufton, which owns a fleet of ships, again, on long-term contracts with very good counterparties. When those contracts come to an end, the COVID situation probably resolved itself, and they're not in the front line. The lessee, might be Maersk or Trafigura, for example, takes the hits for the short-term problems. And again, at one point you could buy that on 8.5% yield, 1.8 times covered. Another example was Yellowcake, which just owns physical uranium, should trade like an ETF, and that was trading on the 25 or 30 discount. So the big opportunity was to buy alternative asset classes in the aftermath of that COVID fright, because they were marked down just as hard as the actual equity.
Great, thank you, Nick. So Charlotte, thinking about the recent months with the COVID-19 pandemic and how it's affected markets. To what extent has it changed the landscape for investment companies? I'm thinking about dividend cuts and widening discounts and that sort of thing.
So I think there's been a couple of key changes in the investment company landscape. Myself and Nick work within the wider Premier Miton team, and we have to say that at this point we're quite pleased we're not running a UK equity income fund. With all of the dividend cuts and cancelling of dividends across the UK market. And so what we are seeing is that we think that investment companies that can still pay their dividend might be very attractive to investors that are starved of income. So something like Tufton that does produce quite a big yield could be very, very attractive. And I think especially those alternative asset classes in the investment trust sector, could be quite popular with investors. On the other side, we did see an enormous amount of widening of discounts through the crisis. So at one point, the look-through discount in our portfolio touched around 34%, which is levels we haven't seen really since the great financial crisis. And so I think what we're going to see going forward is probably an increase in activism, where boards have allowed good trusts to have this, real widening of discounts. I do think shareholders will get more involved in order to narrow those discounts, to change perhaps the capital structure in order to get that value out for investors.
Okay, thanks very much. So Nick, just following on from that point about activism and realising the value in some things. Do you think there needs to be more of that in the investment company sector?
Well, I think the investment trust sector continues to evolve. I've been doing this, I've been doing investment trusts longer than 25 years, but I've been doing nothing other than investment trusts for 25 years. And everyone keeps telling me it's a dying sector and it'll disappear, but it keeps reinventing itself. It keeps doing different things, and I think the consolidations and the changes will carry on. I think we're going to lose a number of conventional equity funds because unless they've got a very specialist mandate, it could be run as an open-ended, and the vast pots of money now need to be able to allocate a lot of money in one go. But I think we'll carry on seeing, the growth of the sector as being a home for alternatives, because If you think of the ones we mentioned earlier, the ground rents, for example, uranium, physical uranium, it's difficult to operate these as an open-ended fund. So I think there will be, there will be change, there will be consolidation. That's the natural home of it. How active are we in these things? Well, it tends to be at a certain point in the cycle. In that very often, when you've been through a new issue boom and you have a crash, some funds, have failed to get a bit of a following. A lot of the new issues of 2007 got tidied up in 2011, 2012, and we were active in that. And I suspect that we're coming up for another phase like that, because there are a number of trusts that have just allowed their discount to go out into the 30s or 40s of percent. And at that point, if your trust's been trading on a 34 discount, and it narrows to 20, why should an investor buy it at 20? Because the risk is it's going to go back out to 34. So it's effectively broken. And I suspect in that scenario, trust should adopt a different capital structure, and probably something very similar to what we have on Miton Global, where we have a realisation window every 3 years, which means that for most of that 3 years, we've got protection from inflows and outflows, which is the key reason why investment trusts outperform. But it does allow people to have a roadmap to cash, that if they buy it, they do know, as long as they're committed to the fund in the medium term, they do know there will be a period to get out of the price which relates to NAV. And I think, recent conversations with an Indian small cap fund, which did allow itself out for a 40 discount, they brought in a new structure, whereas at the end of next year, at the end of 2021, shareholders will be able to opt out for a discount of 6%. And that at least gives it a chance to move on. And I think, inevitably we'll have discussions along these lines with some boards. And I think a lot of boards have probably got to the point of thinking, what do we do next? And I think, this is more of a constructive process rather than, sometimes I think we're sort of pictured as wandering into investment trust boardroom with a samurai sword, demanding cash at NAV now. We just want to see the discounts narrow. Our average discount even now is probably 28%. If we could get that into 15%, which is a more typical figure for the largest 12 holdings, that would add 40p to our NAV. And also, if you allow yourself to languish, you're never going to be able to make any progress. And actually, changing the capital structure will give these trusts a chance to become relevant and to make progress.
Great. Well, we look forward to seeing how that pans out in the market. So just to finish up then, now obviously you two work closely together, although as I understand it, you don't live anywhere near each other. So what have been the challenges and surprises of managing MIGO through the lockdown, both in terms of your own working practices and the portfolio? Charlotte?
I think we've been pleasantly surprised how well we've been able to manage the portfolio from our respective homes. So I'm in Clapham in London, and Nick is in Exeter. I think he's quite pleased at not having to do the round trip to London every week. But we keep in constant contact, and so we found that actually managing the portfolio, there haven't been maybe as many challenges as we anticipated. I think if there was one negative, we do enjoy meeting clients face to face. MIGO isn't necessarily a fund you would necessarily buy off the page. It does take a bit of explaining. We do like to update our investors as much as possible about what we're thinking about in the market and what we've been doing, and any new trusts that have come into the portfolio. And so although it's we're very happy to do client calls whenever, wherever, I think we do miss doing some of the trips up to Harrogate or Aberdeen just to see our investors.
One point actually, which has been on that subject, which has been surprised, is obviously that Miton during the lockdown has merged with Premier, because although the deal was announced in September, the actual integration didn't start until I think it was the 3rd week of April. So we've managed to merge two companies in lockdown. I remember mergers that didn't work and turned up, and the computers didn't work and the printers didn't work when everyone was there. So I think it's quite an achievement to be able to merge two companies in when everyone's working from home.
Yes, that is quite a testament to your IT people, I guess. All right, well, thank you very much, Nick Greenwood and Charlotte Cuthbertson, fund managers of Miton Global Opportunities, for taking part in this Edison audio interview. I've been Sarah Godfrey from Edison, and we look forward to hearing from you again soon. Thanks very much.